Hi guys, it's Doc Curry, and with the Federal Reserve's June meeting wrapping up on Wednesday, I'm going to let you know what people expect the Federal Reserve to do and how the stock market is expected to respond. So let's get into it. Now, in order to understand how the stock market is going to respond to the Federal Reserve on Wednesday, we first have to understand what kind of market we're currently in. And the market that we're currently in is one of high speculation, where we're seeing any and every stock that even mentions the word AI skyrocketing to insane valuations. And this is not unlike other periods in the past. And while it certainly is irrational, it's not unpredictable. And what I mean by that is, if you look at past speculative hype cycles like we're in right now, what you see is during the year 2000, the internet companies, the dot-com companies, were skyrocketing to the moon. Any company that had anything to do with dot-com, any company that even built a website, that stock was going sky high. And then one day, after everybody was focused on the story and how the internet was going to change our lives and how any stock that had anything to do with the internet was just going to go to the moon, all of a sudden one day, the story didn't matter. And people started looking at the fundamentals and asking themselves, how is this company going to make money? Because ultimately, when you invest in a stock, you're investing in a company. And ultimately, that company needs to be profitable and it needs to make money and show a return. Unfortunately, the vast majority of the dot-com stocks failed to do that, and most of them went out of business or got bought out. Now, of course, in any speculative hype cycle, there's always going to be some winners. Apple was probably the biggest winner from the dot-com bust. Then we saw a very similar thing happen in the year 2020 and 2021 for about a 6-month period there, where stocks just skyrocketed, and any stock that had any sort of growth story was just going to insane valuations. And everybody at that time said valuations don't matter. Just look at the story. Look at what this company is going to do. Look at the product that they've created. Look how they're going to change the world. Look at the incredible technology. And it was all about the story. And the fundamentals didn't matter until one day in April 2021, they did. And all of a sudden, the story didn't matter. And everybody asked themselves, but how is the company going to make money? And a lot of the stocks that have run up to insane valuations fell, and a lot of people's portfolios were down between 60 and 90%. Of course, there are always going to be some winners, and Tesla was by far the biggest winner from that period of speculative hype in 2020 and 2021. It ran up the most and stayed up. And so people who got lucky and threw all of their money into the one stock that happened to be the winner, they come out and they look like geniuses because they turned $1,000 into $1 million or whatever they made. And everybody looks at them and says, oh, wow, look at this genius. What's next? What's next? What's next? And a lot of times those people don't know what's next because truth of the matter is they kind of got lucky and just happened to pick the one stock that went up when the other 99 went down. And the same thing is going to happen right now in the speculative hype cycle that we're currently in. In this AI hype cycle, where any company that has anything to do with AI is rising, and it's all about the AI story and how it's going to change our lives, and the fundamentals don't matter, eventually, one day, the fundamentals will matter, and the story won't. And a lot of those stocks are going to crash. And one or two are going to end up being the big winners. Now, what stocks are going to be the big winners? Well, nobody really knows right now, and we're not going to know until a few years down the road. But one thing I can guarantee you is the few people who got lucky and picked those winners, they're going to be on YouTube talking about how much of a genius they are. While most people, most of their followers, and most people who invest in these AI stocks are unfortunately going to be the big losers. Now, timing that is very important to understand. These speculative hype cycles generally run for about 6 months to a year. And the current AI hype cycle that we've been in, it's really been running for about 4 months or so. So it's most likely not over yet. Most likely we've got more room to run. Stocks are at pretty high valuations, many of them running in between 70 and 300 PE ratios. But as high as those PE ratios are, and as insane as those PE ratios are, they're not as insane as stocks normally get when we enter these extremely speculative hype cycles. We typically don't top out until stocks have hit PE ratios of between 500 to 1,000. So it would seem like we've got a lot more room to run up before we top out. That said, investors are taking a couple of different approaches to this. Take a stock like Tesla, which is now up 13 days in a row. By the way, that's never happened before in history. Never before in history has Tesla risen 13 days in a row. The last time Tesla rose this much, it rose 11 days in a row. It topped out on November 3rd of 2021, and the very next day started a 14-month decline. Of course, all stocks went down in 2022, so unlikely that'll exactly repeat itself again. But generally, when stocks run up like this, they usually have some sort of pullback. Over the last 13 days, Tesla is up 41%. Meanwhile, the NASDAQ over the last 13 days is up 10%. And the NASDAQ would normally run up 10% in an entire year. It just did that in 13 days. So we are definitely due for a bit of a pullback. But when that happens, nobody knows. But certainly, even though we may not know the day or the time, we can certainly see the season when this might happen. And it's led some investors to take a lot more of a dovish stance, if you will. Some investors who are a little bit long-term are saying, I'm certainly not going to buy any more at these levels, but I'm not going to sell. I'm just going to hold up on cash, wait for a pullback, and then start buying some more. Others, especially some large institutions, are saying, it's probably a good idea to sell and take profits at these levels and then hold cash and rebuy a little bit lower down the road. Of course, trying to time exactly when a stock like Tesla will fall, or Nvidia, or any of the other stocks that have run up to very high PE ratios, trying to time that is next to impossible. But knowing that we're in the season, a lot of people are either selling and taking profits, or they're just stopping their normal buys and holding cash and waiting for a bit of a pullback. So now that you understand kind of where the market currently is, and that we are in this extremely greedy speculative hype cycle, and yet we're probably not at the end of it yet, we're probably going to keep going up more from here. Let's take a look at what the Federal Reserve is expected to do on Wednesday and how the stock market is expected to respond. Understanding what the Federal Reserve is going to do starts with understanding where inflation is at, because the Federal Reserve's number one goal right now is to get inflation down. And the Consumer Price Index, or CPI, just came out on Tuesday, and it came right in line with expectations. The headline CPI rose 0.1% month over month and 4% year over year. And core CPI rose 0.4% month over month and 5.3% year over year. Now, the big story is the headline CPI, which is now the lowest in 2 years. And with headline CPI coming down, this leads most people to expect the Fed to pause on Wednesday. The Federal Reserve is now pricing in a 94% chance of a pause on Wednesday. And the expectations of the Federal Reserve pausing are of what led to a lot of the rally over the past week and a half. But it's important to understand that just because the Federal Reserve pauses in June does not mean they're going to stop raising interest rates. They might pause in June and then raise interest rates in July. And that's exactly what CME futures traders are predicting. They are expecting the Federal Reserve to pause in June and then raise in July. In fact, the CME futures have a 35% chance of the Fed pausing in June and pausing in July, and a 60% chance of the Fed pausing in June and then raising interest rates in July. Treasuries are also pricing in the Fed pausing in June and then raising interest rates in July, as seen today as Treasury yields climbed on the CPI reports. So if CPI came in line with expectations and the headline CPI or inflation data is down to 4%, the lowest in 2 years, why would the Federal Reserve raise rates again in July? Well, the reason is because the Federal Reserve isn't so focused on headline CPI, they're focused on core CPI. And core CPI remains stubbornly high at over 5%. Remember, the Federal Reserve wants to get core CPI down to below 2%. And the fact is, the interest rates they've done so far don't appear to be working or doing their job. And as a result, this is leading both futures traders as well as bond traders to predict that the Federal Reserve is going to have to raise rates again in July. But the stock market isn't pricing this in. In fact, the stock market is pricing in the Fed not only pausing in June, but actually cutting rates later this year. While futures markets and bond markets are pricing in the Fed continuing to raise rates. And so this has a great disconnect in the stock market from what's generally considered more sophisticated futures and bonds traders are predicting the Fed to raise rates, and yet the stock market's predicting the Fed is going to cut rates later this year. And depending upon what happens tomorrow, this could have a significant impact on the stock market. Now, while the Federal Reserve is widely expected to pause in June, what the stock market is really going to be looking for is what Jerome Powell says at the press conference and what he forecasts for July. Because if Jerome Powell leaves the door open or even hints at the possibility of raising rates again in July, we might see the stock market absolutely crash, because that's not what the stock market's pricing in. But if the Federal Reserve pauses in June on Wednesday, and then Jerome Powell comes out and gives strong indications that they are done raising rates, they're not going to raise rates anymore this year at all, then we can expect the stock market to rally, because that uncertainty is now gone and the stock market is getting exactly what it wanted. And the fact is, if the Federal Reserve did stop raising rates and didn't just pause, this would be really good for stocks. And that's why top corporate chief financial officers are sending direct messages to Fed presidents asking them not to pause, but rather just to stop raising rates altogether. And we will get the Federal Reserve's decision on whether or not they're going to pause in June at 2 p.m. Eastern Time. That's about 2 hours before the market closes. Then 30 minutes later at 2:30 p.m. Eastern Time, Federal Chair Jerome Powell is going to hold a press conference, and that's where we are going to get some insight into what they plan to do in July. Are they going to pause and possibly raise rates in July, or are they going to stop and they're done raising rates? Now, another thing to keep in mind with how the stock market might react is the current market psychology. And the current market psychology is an extreme greed, meaning people are buying any and every stock, regardless of fundamentals. They're just buying. Now, extreme greed is very helpful for a bullish stock market. It really helps push stocks up. And that's why if there's any indication that the Federal Reserve might actually stop raising rates altogether this year, I would expect the stock market to continue to rally. However, there's always the chance that the Federal Reserve doesn't do that something unexpected happens. And this is the risk with an extreme greed environment, is that it doesn't take very much news for a rug pull to happen. See, when stocks are down, say 20%, in order for stocks to go down another 10%, when they're already down 20%, you need some pretty significant, majorly bad economic news to cause stocks to go down another 10%. But when stocks are already up 20% on the year, and there's the possibility for stocks to drop, say, 10%. It really doesn't take a lot of bad news, and it takes very minor bad economic news to cause a rug pull and to cause stocks to go down when stocks have run up so much. Because right now, everything has to go perfect in order for stocks to continue to run up. And if there's any indication at all that things aren't perfect, that could cause stocks to all of a sudden turn around and have a little bit of a correction. I'm not saying hit new 52-week lows, and I'm not saying that at all. I'm just saying a little bit of a correction, like a 5-10% down, and then we keep going higher. Just something to kind of fix this extremely speculative hype cycle, this extreme greed cycle that we're in. We just need just a little bit of a pullback to kind of fix this, get us back to a little bit more normalcy, and then we can go up higher in a more healthy way that isn't going to cause people so fearful of an upcoming pullback. Once the pullback's over, great, we're good. We got through it. We got our 5-10% pullback, whatever. Now we can keep going up. But right now, there's a lot of fear there that, okay, maybe there might be a little bit of pullback here. And that's kind of why we've seen the VIX skyrocket over the last 2 days, is people are getting a little bit fearful of, hey, anything could happen that could cause a rug pull here and cause stocks to drop. Now, of course, for me, for people in my coaching program, it doesn't matter if stocks are going up, going down. We don't care. We're going to make money anyway. And if you didn't know, part of the coaching program, we have some very intensive masterminds that are done with Coach K, who's a very successful trader. And last month in the mastermind, in the May mastermind, they collectively did some trades, and Coach K made $13,000 on the trades that she did in the May mastermind. Now, not everybody followed every trade, but if you had followed every trade, you could have made $13,000 last month. Look, if you want to make this kind of money in your portfolio, I encourage you to take your education to the next level. Go beyond the coaching program and get into a mastermind where you can get some intensive one-on-one help from Coach K and really learn how to make the big money. Not just learn how to become profitable, but learn how to make extreme amounts of money so that you can quit your job, trade full-time, spend time with your family, accomplish your dreams, travel, do whatever it is that you want to do. I encourage you to come join Coach K's Masterminds. We are starting the next session in just a few weeks here. So get a call with my onboarding specialist where you can jump in there, schedule that call, and get some more information on that. You can schedule a call with the onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. Keep in mind, these masterminds are limited to 10 people. We've already got a few people who have signed up, so there's only a few slots left. If you want to get in there, you want to find out how to make big money so that you can quit your job and accomplish your dreams and travel and spend time with your family, then schedule a call with the onboarding specialist. Let's get you into this mastermind and teach you how to make money in the stock market. If you got a lot out of this video, then be a good friend. Share this video on your social media pages so that others will know how to make money in the stock market as well, and they'll get prepared for the Fed meeting. Don't forget to hit the like button and subscribe. And if you missed the video I uploaded yesterday, make sure you watch the last video here.